Welcome to the deep dive. Today, we're really digging into Japan's incredibly intricate world of cryptocurrency laws and regulations. Our mission, let's try and cut through all that complexity. We want to understand how Japan, a major global player, actually defines, governs, and taxes these digital assets. We've pulled together some really comprehensive legal insights, government acts, taxation specifics. Basically, this is your shortcut to getting properly informed on a critical global financial topic.
And looking at Japan is so valuable precisely because they're one of the few major economies that actually has explicit, detailed crypto regulations already. They're not just reacting. So this gives us a fascinating look at a sort of forward-thinking approach to integrating these new assets.
Okay, so how does Japan even start to make sense of something as, dynamic as crypto, especially a country known for planning and stability? It seems to kick off with two main laws, right? The Financial Instruments and Exchange Act, FIEA, which is, from 1948 originally.
Yeah, quite on.
And the newer Payment Services Act, the PSA.
That's right. And what's really interesting is how they divide things up. The FIA, it mostly handles traditional securities. Now, most crypto assets, just by their nature, they don't really fit that old mold. So usually they fall under the PSA.
Usually.
But, and this is the key part, Japan has created some very specific exceptions. Certain crypto assets get pulled into the FIEA framework. They're treated almost like regular investments.
Okay, and this is where it probably gets really important for you, the investor listening. Things like security tokens, ICOs, initial coin offerings.
Okay.
The FIEA amendments, they actually call ICO tokens Type 2 securities, and these represent interests in collective investment schemes. So an ICO in Japan, that's a specific legal category.
Right, and the practical difference between these Type 2 securities, like ICOs, and your Type 1, like traditional stocks and bonds, well, it's significant for reporting. Type 2 generally means less strict disclosure rules, mainly because they're often sold to smaller, specific groups, not just the general public.
They're not unregulated.
Oh, definitely not. There's another layer, the Japan Security Token Offering Association, the JS2I. It's a self-regulatory body, an SRO, that oversees these digital coin offerings, adds more authority.
Got it. And then there's another category, electronically recorded transferable rights, ERTRs.
Yes, ERTRs. Now, these look a bit like security tokens issued with an expectation of profit.
Okay.
But here's the twist. Legally, they are not considered crypto assets under FEA, and that means they are explicitly not covered by the Payment Services Act.
Huh. So what makes something an ERTR then? It sounds quite specific.
It is. Three key things have to be true. One, investors put cash or assets into a business. Two, those investments are actually used in that business. And three, investors get rights to profits or assets from those investments.
So for you, the listener, figuring out if a token is FEA or PSA, it's not simple.
No, it's a case-by-case thing. You have to look at the token-specific features, its purpose, the whole setup. It's a question of fact.
Okay, so FEA handles the investment-like tokens. What about, everyday crypto use, the exchanges we all use?
That's where the Payment Services Act, the PSA, really comes in, especially after its 2020 amendments. It's the heavy lifter for defining and regulating what Japan just calls crypto assets and the exchanges themselves. It basically pulls them firmly into the main financial system.
And how specific are we talking with definitions?
Oh, remarkably specific. It's foundational to how they regulate. A crypto asset is property value that's recorded electronically, transferable electronically, not traditional money, usable for payments, and buyable, sellable.
Pretty clear.
And exchanges. Businesses that let you buy, sell, exchange crypto, or act as middlemen, or crucially, hold your funds. This isn't just legal noise, it's the framework for applying protections.
And those protections, they have clear goals for the user, for you. The amendments aim to, shield you from hacks.
Exactly. Better protection against exchange hacks is a major one. Also, creating a much clearer regulatory environment overall, and limiting risky stuff, like margin trading. They put strict caps on leverage, like 4 times or less.
Makes sense. And who enforces all this?
Compliance is huge, as you'd expect. The Japan Financial Services Agency, the JFSA, is the main economic regulator here. Exchanges can't just set up shop. They need to register with the JFSA, get a license. They have to do serious customer checks, KYC, know your customer,
Right.
keep detailed records, constantly improve security. And the JFSA leads the anti-money laundering and counterterrorism financing efforts too. Financial institutions need risk-based plans, compliance officers, the works.
Okay, and you mentioned holding funds. There's something specific there that helps users, right?
Yes, this is critical for you as a customer. Exchanges must keep customer funds separate from their own money. Segregation,
That seems standard.
it goes further. They have to hold the same kind and the same quantities of crypto assets as what their customers hold.
Ah,
So
ugh.
if there's a theft, there's a specific pool of the right kind of crypto set aside to make sure you get reimbursed. That's a significant safety net.
That really is. And keeping up with how fast crypto changes. How do they manage that?
Good question. The PSA did something clever there. It designated the Japan Virtual and Crypto Assets Exchange Association, JVCEA, as an official SRO, a self-regulatory organization. This JVCEA acts like a bridge, connecting the government regulators, the JFSA, with the actual exchanges.
Drawing on industry knowledge.
Precisely. They can use industry expertise to create practical rules faster than, typical government processes might allow. And importantly, all exchanges, registered or not, are expected to follow JVCEA guidelines.
Okay, let's shift gears. The big one for many listeners, taxes, the elephant in the room. Here's something that surprised me. Since 2017, crypto transactions in Japan are actually exempt from consumption tax.
That's right. It's a fascinating quirk. So if you, say, buy a coffee with Bitcoin in Tokyo, you technically shouldn't pay sales tax on that specific crypto transaction.
Huh. Okay, but that's not the whole story on tax, I assume.
Not even close. While consumption tax is off the table, any gains you make from selling crypto or even using it if its value went up, that's definitely taxed. Japan's National Tax Agency, the NTA, classifies it as miscellaneous income.
Miscellaneous income, how does that compare to, say, capital gains on stocks?
Very differently, and this is where it gets, well, potentially painful for investors. It's not a flat rate like the usual 20% or so on stock profits.
Oh,
Your crypto gains are hit with a progressive tax rate, just like your regular income tax.
progressive. So the more you earn overall, the higher the rate on your crypto gains.
Exactly.
Yeah.
For residents, it can range from 15% all the way up to a, frankly, whopping 55%. That includes the national rate, which goes up to 45% for income over 40 million yen, plus a flat 10% local inhabitant tax on top.
Wow, 55%. That's high.
It is. Non-residents face a flat 20% on income when they leave, but depending on other income, the total progressive rate could range from 25% up to 65%.
Why so high, though? Why not treat it like stocks?
That's a deliberate policy choice. The finance minister, Taro Aso, explicitly said they didn't want to tax crypto like stocks. They see it differently. And another critical point that really bites. You cannot deduct your crypto losses to offset your crypto gains in Japan.
Ouch. So if you have a bad trade, you can't use that loss to reduce the tax on a good trade.
Nope, that loss just
Yeah.
sits there. It significantly increases the effective tax burden compared to other investments. And yes, inheritance tax applies too if you pass on crypto assets.
Okay, so high rates, no loss offsets.
Yeah.
This must create some temptation to, well, not report everything.
It certainly creates an incentive, yes. And the NTA, the tax agency, knows this. They are actively targeting noncompliance.
Any examples?
There's a pretty stark one. An office worker, Hideji Matsuda, was fined about 22 million yen, that's roughly 200,000 US dollars, and sentenced to a year in prison
For what?
for not disclosing his crypto trading profits from 2017 and 2018. It shows just how serious the government is about enforcing these rules. Tax evasion is not taken lightly.
A very clear message. So stepping back then, looking globally, Japan really seems to be out front with this comprehensive framework, even if it's complex.
Absolutely, it stands out. Many other countries are still figuring things out, lacking clear laws, especially in niche areas like, say, crypto mining. Definitions there are all over the place. Is it money transmission like in the US? Is it a business taxed on income like in Israel? Japan, for better or worse, has put detailed rules in place across the board.
Yeah, it feels like a very proactive approach, trying to integrate digital assets properly, focusing hard on investor protection, market stability.
That seems to be the priority.
For you, the listener, understanding this level of detail gives you a really crucial insight into how one major economy is trying to handle the future of finance. It could be a blueprint or maybe a warning for others. So, as we wrap up this deep dive, here's something to think about. Japan's got this rigorous framework, right? Especially the high progressive taxes and the tough penalties if you don't comply. Does that kind of approach ultimately build confidence and encourage real innovation in the long run? Or does it maybe risk pushing crypto businesses and activity offshore to places with, shall we say, lighter regulation, potentially slowing down growth within Japan itself? Something to mull over.